Right now, Japan is sitting on what looks like the most dangerous quiet crisis in the world. Japan's government debt load is routinely cited north of 230% of GDP, the highest in the developed world. IMF data mapper Japan also remains the biggest foreign holder of U.S. Treasuries, about $1.2 trillion. Says U.S. Treasury T's, Table 5, and global debt overall has surged toward a scale that makes every shock contagious. Reuters cited IIF data putting total debt near $345.7 trillion by end of September 2025. Reuters. Here's the shocking claim. Japan's debt bomb isn't a Japan story, it's the next phase of a repeating historical pattern, and the U.S. is sitting directly downrange because Japan is woven into U.S. rates, U.S. liquidity, and U.S. financial stability through treasuries, currency flows, and leveraged global trades. This isn't a prediction, it's a sequence. Once Stage 3 starts, Stage 4 always arrives, and Japan is already showing Stage 3 symptoms, long bond yields ripping higher in a system that was never supposed to allow it. Trading economics, Japan 30Y yield. So if you're in the US and you think, cool, that's across the ocean, you're about to learn the hard way how global finance actually works, because the first shock doesn't hit you where it starts, it hits you where the leverage is, and the leverage is everywhere. Before we get into it, quick favor, if you want the follow-up breakdown of exactly how this connects to US mortgage rates, stock multiples, and the next liquidity squeeze, subscribe now, because this is not a one video situation. This is a chain reaction situation. Now let's walk the system. There are 4 stages. They show up in empires, they show up in companies, they show up in households, they show up in nations. Stage 1 is setup, the foundation gets built, a country finds a growth engine, the world trusts it, money flows in, the system becomes stable. Stage 2 is expansion. Debt grows faster than the real economy. Policymakers call it stimulus, markets call it support, the public calls it normal, and the central bank becomes the invisible shock absorber. Stage 3 is crisis. This is where the system starts to lose control, not in headlines at first, in the plumbing. Bond market volatility, currency weakness, rising refinancing costs, political pressure, a slow motion run. That suddenly turns into a sprint. Stage 4 is the inevitable outcome, and there are only a few versions of it. Inflation, default or restructuring, financial repression, currency devaluation, or a controlled decline that still destroys whoever is positioned wrong. Think of it like a pressure cooker. Stage 1 is buying the pot. Stage 2 is turning the heat up and telling everyone you have it under control. Stage 3 is when the lid starts rattling. Stage 4 is when something gives. Maybe it's a valve release, maybe it's the lid, but it always releases. Now I'm going to prove the pattern with 3 historical case studies, and I'll keep them tight. Because the goal isn't a history lecture. The goal is to show you that the pattern is undefeated. First example, Britain after World War II. Britain enters the 20th century as a dominant global power. Then war costs explode, debt rises, the pound loses strength. And even when Britain wins, the cost base is broken. Here's the key part. Britain didn't implode overnight. It managed decline. It used policy tools. It leaned on credibility. But the outcome still happened. The pound was devalued in 1949. The empire shrank. And Britain's global financial dominance ceded to the U.S. in a slow but irreversible transfer of power. That's the pattern. Not collapse, loss of control, followed by loss of position. And the cliffhanger question is obvious. If that happened to Britain after being the center of global finance, why would Japan be immune? Second example, Latin American sovereign debt crises in the 1980s. Stage 1, access to cheap money. Stage 2, debt expansion. Stage 3, rates rise externally, currency pressure hits, refinancing becomes impossible. Stage 4, restructuring, austerity, and a lost decade. What makes this relevant is not that Japan is like Mexico or Brazil. Japan's situation is structurally different. What's relevant is the mechanism. When your debt is sustainable only under one rate regime, and that regime ends, math becomes destiny. And here's the cliffhanger. Japan's entire debt model was built on ultra-low yields. So what happens when Japanese yields stop behaving? Third example, the US in the 1970s. This is the one people hate to hear, because Americans are trained to believe we're different. But the pattern still touched the US. Debt grew, spending grew. The system chose inflation as the release valve, and inflation changed everything: wages, savings, asset prices, politics. The US didn't default. It used the most ancient tool in the book. It changed what the debt meant by changing the value of the money. That's stage 4, American style. And that's the cliffhanger. If the US used inflation as the release valve before, what makes you think it won't again? If Japan forces US rates higher at the worst possible time? Now we apply the pattern to Japan, step by step, no fluff. Stage 1, setup. Japan built a post-war miracle: industrial power, export engine, high savings, strong institutions, a currency the world respected. Then the 1990s hit. Asset bubble burst, growth slowed, deflationary psychology set in, so Japan made a choice. If growth won't come naturally, we will finance stability. That's the seed. Check. Verified. Undeniable. Stage 2. Expansion. Japan's state debt grows into the largest developed nation debt burden on Earth. IMF data mapper. And here's the key mechanism that most people don't emotionally internalize. Japan didn't just borrow. Japan engineered the price of borrowing. The Bank of Japan spent years doing extraordinary monetary policy, yield curve control, quantitative easing on a historic scale, and the result was something almost no other major nation dared to do at that intensity. The central bank became the market. Multiple reports and analyses have noted how massive BOJ ownership became. Over 50% of outstanding Japanese government bonds has been reported in prior periods. Nikkei Asia, BOJ 50% of JGBs. So imagine a stadium where one buyer purchases half the tickets and then claims ticket prices are stable. They're stable because the buyer is forcing them to be stable. That's stage 2. Check. Verified. Undeniable. Stage 3. Crisis. Loss of control. Now watch what starts breaking first. It's not GDP. It's not some dramatic televised collapse. It's the bond market, and it's the currency. Japan's long bond yields have surged, with the Japan 30-year yield reaching levels described as record highs in recent data feeds. Trading economics, Japan 30Y yield, and the yen has shown repeated episodes of extreme weakness, including moves that drove it to multi-decade lows in 2024. Reuters explainer on yen intervention history. This matters because Japan imports critical inputs: energy, food, industrial commodities. A weak yen increases the local currency cost of living and corporate inputs, feeding domestic pressure. Export finance Australia. So Japan's trapped between two fires: raise rates to defend the yen, debt service costs surge, government budget strain intensifies, keep rates low to protect debt affordability. Yen weakens, import inflation bites, public anger rises, and credibility erodes. That is stage 3, the trap. And now layer the geopolitical stress. If Chinese tourism weakens because of political tensions, that's not just bad vibes. Tourism is real cash flow for businesses, and Chinese visitors have been described as top spenders in Japan. Nippon.com, Chinese visitors' biggest inbound spenders in 2025, and geopolitical frictions have been linked to travel warnings and boycotts that could hit Japan's economy. Reuters. Meanwhile, the demographic gravity keeps pulling. Japan's population peaked around 128 million in 2010 and is projected to shrink dramatically in the coming decades. Reuters graphics, Japan aging. And the adult diapers versus baby diapers shift is not a joke. It's been widely reported as a symbol of aging demand patterns. BBC. This is what makes Japan uniquely fragile: a shrinking workforce, a rising retiree base, a massive debt pile, and a bond market that is starting to behave like a real bond market again. Check. Verified. Undeniable. Now, stage 4 is where people get uncomfortable, because stage 4 isn't one thing. It's the outcome the system chooses when it runs out of room. Japan's stage 4 possibilities compress into a few tracks. 1. Financial repression. Rates held below inflation as long as possible. Savings quietly taxed. Currency weakens over time. 2. Inflation as release valve. Not hyperinflation necessarily, but a sustained regime shift where prices rise faster than wages and the debt load becomes easier only because the currency buys less. 3. Forced fiscal consolidation, higher taxes, lower benefits, cuts, political volatility. 4. Destabilizing bond market event that forces a reset, not apocalypse, but a sudden repricing that breaks institutions that were positioned for stable yields forever. Now here's where the US gets hit. Not because Japan wants to hit the US, because the system is wired that way. Japan holds about $1.2 trillion in US Treasuries. US Treasury TIC, Table 5. So ask yourself a simple question. If Japan faces domestic stress, where does it find liquidity? It can't print dollars. It can sell dollar assets, and treasuries are the most liquid thing on earth. Even the fear of forced selling can move markets. And if US Treasury yields rise, what moves next? Mortgage rates, corporate borrowing costs, discount rates on stock valuations, commercial real estate cap rates, the entire American soft landing narrative. This is why Japan's crisis can become America's problem. Now add one more amplifier, the yen carry trade. When Japan's rates are low, Global players borrow yen cheap and buy higher yielding assets elsewhere. That includes US assets. If Japan's yields rise and the yen strengthens suddenly, or volatility spikes, leveraged players unwind. They sell what they can. They buy back yen. That can become a global risk-off cascade. This is exactly how modern contagion works. Not Japan defaulted, but positions got squeezed. Now here's your mid-video CTA, and I mean it. If you want the next segment where I map out the exact contagion pathways into US housing, US banks, and US equity multiples and the 3 warning indicators you can track weekly, subscribe right now, because the people who wait for CNBC to panic are always the exit liquidity. Now let's lock the mechanism into your brain with one clean sequence. Japan's bond yields rise. Trading economics debt service costs rise. Fiscal pressure rises. BOJ credibility gets tested. Yen volatility increases. Reuters foreign investors demand more yield. Domestic institutions rebalance. Global carry trades wobble. Dollar liquidity tightens. And then, because Japan is a core node of global savings and US Treasury demand, US yields can rise at the exact moment the US can least afford it. That's the part people miss. It's not that Japan is big, it's that Japan is connected. Now let's kill the comforting myths, because these myths are how people get destroyed in stage 3. Myth 1, this time is different. No, the details change. The mechanism does not. A debt system dependent on suppressed rates always breaks when rate reality returns. Myth 2, technology will save us. Robots don't refinance bonds. AI doesn't reverse demographics on a timeline that matters. Productivity helps, yes, but it doesn't erase the math of debt service in a rising yield regime. Myth 3, American exceptionalism. The US is exceptional in many ways, but it is not exempt from higher yields, and the US is not insulated from global deleveraging when global debt is near record levels. Reuters now practical takeaways, not hype, not doom, positioning and preparedness. First, stop thinking in countries. Start thinking in linkages. If you own US stocks, you own duration risk, because stock multiples are sensitive to discount rates. If Japan contributes to higher US yields, that is your problem even if you've never touched a Japanese ticker. Second, understand your exposure to rate shocks. If your financial life depends on refinancing, cheap credit, or high valuations staying high, you're on the wrong side of stage 3. Third, build a liquidity-first mindset. In contagion phases, the best assets aren't the ones with the highest returns. They're the ones you can actually hold through volatility without being forced to sell. That means keep emergency cash, reduce leverage, avoid fragile balance sheets, avoid concentrated bets you can't emotionally sit through. Fourth, watch the 3 tripwires. Japan, 30-year yields continuing to make new highs. Trading economics. Japan's US Treasury holdings and shifts in foreign demand. US Treasury TIC, Table 5, and yen volatility, intervention risk as stress indicators. Reuters. Fifth, don't ignore second-order effects. Japan's demographic strain is the slow pressure. Reuters. But the market repricing is the fast trigger. Markets don't move when problems exist. Markets move when problems stop being ignorable. That's why stage 3 is always the most dangerous. Now the conclusion. Japan is not about to collapse tomorrow. That's not the point. The point is that Japan is entering the phase where control becomes expensive, and expensive control always spreads costs outward. Japan's bond market behavior is changing. Trading economics. Japan remains a major pillar of US Treasury ownership. US Treasury TIC and global debt levels are so extreme that any tremor can become a global event. Reuters. This is the pattern. Setup, overextension, loss of control, inevitable outcome. And the only real question is not if. It's who is positioned to survive stage 4, and who is positioned to finance everyone else's survival. Final CTA, subscribe, because the next connected segment will lay out the exact US transmission channels, Treasury yields, carry trade deleveraging, and the liquidity spiral, plus a simple personal risk audit you can run in 10 minutes to see if you're exposed.